Bloomberg Audio Studios. Podcasts, radio, news.
After the latest jobs numbers, which came out just under an hour ago, some mixed messaging coming from it. Where do you concentrate on? Let's bring in BlackRock's Chief Investment Officer of Global Fixed Income, Rick Rieder. And Rick, great to see you this morning. Thanks for joining us. I'm sure you've been poring over the numbers. What is the concentration? Is it growth that comes in less than expected? Is it the revisions for October and November? Or is it an unemployment rate now just at 4.4%?
So I think what Mike McKee said was right in that, the Fed talked about the unemployment rate. I have to tell you, I have a different take on it. I think there is we're talking about 50,000 jobs and then a revision down over 70,000 jobs. We're growing now. If you go to last 6 month moving average, if you take out healthcare jobs, we're actually running negative jobs for the last 6 months away from healthcare, which is non-cyclical, not interest rate sensitive. Actually, if you go back 8 months, the total net jobs is negative 213,000 jobs net of healthcare. What I think is going on is we have a productivity revolution of extraordinary proportion, that we have an economy that's growing at a quite robust rate, but we just don't need the people. And I know when people say, well, they were focused on, could this be 60,000 jobs, 70,000 jobs, 80,000 jobs? If you go back to 2021, now that was post-COVID, we were running 600,000 jobs. Now, big pullback from 20, but then in 22, 380,000 jobs a month. 2022, you were running 217,000 jobs. 24, you were running 170,000 jobs. We're talking about last year, you ran 50,000 jobs. Net of healthcare, no jobs. This year, you're running at a number, well, we just saw 50,000, 39,000 was in healthcare. Point being, and part of why I think the interest rate tool doesn't really affect healthcare and doesn't really affect education, which was another part of the job market. Meaning, I think we're just seeing a productivity revolution. I mean, you break down the numbers, you really look at it, it's pretty extraordinary. And I think the labor dynamic is quite significant on the backside of that.
Where do you see that, Rick? Because I was just listening to Odd Lots, the Odd Lots podcast that Joe and Tracy do with Jan Hatzius from Goldman Sachs. He says that AI has added about 20 basis points of productivity to growth. And their new incoming chief equity strategist, Ben Snyder, said out of all 500 S&P companies, only 6 have been able to quantify added productivity from AI. So I hear about it all the time, and I see the stock soaring, but what's the evidence that we have actually increased productivity with these tools?
So, by the way, Jan's right as normal, as usual. I will say one thing. People like to take productivity and say, oh, it must be a 2-letter word, AI. AI is coming. By the way, so is robotics, so is automation, so are those forms of productivity. But if you go back the last 2 years, and I broke it down on a call we did, logistics, inventory management, customer procurement, freight, how you use freight, efficiency of how you manage your inventory, efficiency of how you manage your receivables. Every company today is running. Why is revenue growth a decent place? But what's really happening is earnings growth is spectacular. Earnings growth is spectacular because you're reducing your cost infrastructure. Cost of goods sold, SG&A are coming down because you've come up with a better way to actually run your business, and you're using software, cloud, inventory management tools, et cetera. So I think AI is coming, and I think it accelerates what is a productivity boom. But I agree with you. I agree with what Jan said. Today, it's not AI. And by the way, you look at the M&A calendar, and which I think will continue to be robust, to say the least. Why will you see so much M&A? Some of it you have business incentives that are real. Some of it is you have businesses trying to build a moat, create more data, et cetera. A lot of it is synergistic, i.e., I can grow my company, I can build scale, and I can reduce my cost ecosystem. And that, what that means is fewer jobs. And I think we're watching it. And I don't think the story is ambiguous. I think the story is quite clear. We have a labor dynamic.
Right.
That is tricky. And by the way, it's a lower skilled problem. It's an urban problem. It's that I think is, part of why I think, I've been pretty adamant that I think the funds rate needs to be, I think interest rates need to be a bit lower because I think it's lower skilled. I think it's low income. I think it's small business that are on the backside of what is a tough dynamic today.
I want to get to that, and I know Dani does too, in terms of rates, but I want to get to what you think we need in terms of adding jobs, because we have zero immigration, and we're close to a population declining. We're not having kids in this country. So to me, 4.4% unemployment, in that picture, especially with 3.8% wage growth, that looks good.
So by the way, it's 4.4, trending significantly higher from where we used to be. And by the way, I would argue if you took a step back and said, gosh, 4.4, is that a crisis? Unequivocal that that's not a crisis. The trend isn't a good story, number one. Number two, we have a dynamic, and I think when people say it's a supply, that it's an immigration dynamic. If you look at the demand function, and so you look at the JOLTS data this week around job openings, and you look at the trend there. And again, I'm not saying we're in a jobs crisis today, but if you took a step back and said, gosh, I want to look at the big picture, and I go back to where we were in terms of what jobs were created in 22, 23, 24, we could strip out the COVID dynamic. And then you say, where are we going? Where we're going is a place from a labor perspective that I think is a bit concerning. And I think, one man's opinion, I think you have to be a bit anticipatory. We've been talking about this, for 9 months where the funds rate was at 4 3/8. And by the way, I don't think we need to go that far. I think we got to get the funds rate down a bit to 3%. We've been talking about that every month on this show. And I just think you got to get there because I think that's the equilibrium rate today.
Rick, I just wonder though, even if you get there, how does that change these very macro trends you're talking about? I mean, that doesn't change this push to productivity. That doesn't put a cap on AI and maybe its ability to replace workers. So if you lower rates, does it really have as big of an impact on the labor market this time around?
So the answer is you're right, and it's like, does the Fed create jobs? And the Fed have one tool to create, and this argument the Fed has one tool. And by the way, it's not just the Fed. I actually think most of what you're describing needs to be accomplished through fiscal initiatives. And so, by the way, obviously a lot of news recently about the housing market. Well, I think the housing market is such a profound dynamic. And part of why I think that influence is so significant. And by the way, I actually don't think the Fed funds rate is that critical. I think it's longer term interest rates you got to keep down because you got to get the mortgage rate down. What happens if we get housing moving? If you get housing moving, you create more labor mobility. You see a job in another state, another city, you can move. That's important. We create, every house built in this country creates 3.1 jobs from people building houses. That creates, and it's, by the way, it's hard to AI building a house today. That creates an improvement in employment. And then I think there's a whole series of other things around technology, et cetera, that I think most of it on the fiscal side. But I agree with you. I think that is the trend. So then you go back and say, okay, so then what is the equilibrium rate of interest relative to that? If inflation break-evens are 2.3% and inflation projections by UMich are certainly well contained, then I think, my point being is, yes, we have a productivity revolution. It's hard for the interest rate tool to solve it, but I think there's a whole series of things that can ameliorate some of what is a problem today. And will be a bigger problem.
Rick Rieder here, BlackRock's Chief Investment Officer of Global Fixed Income. And this is so interesting. I mean, President Trump, not only has he this week said he doesn't want like Steve Schwarzman buying homes anymore, or any institutional buyers of homes. At the same time, I think President Xi of China reminds us that homes are for living, not investments. And you've got President Trump now doing Oval Office QE, like telling his guys at Fannie and Freddie to buy $200 billion of mortgage-backed securities. Does this help, Rick? Do you think the housing crisis that you were talking about?
So I won't comment on a specific initiative. The only thing I will say is something there. I think housing is pivotal. By the way, I normally think people underestimate how important 3/4 of the wealth in this country by people is in their home. And the way young people build wealth is through their home. The way the normal, by the way, I would even translate it. I would even relate it to, I've showed a chart on fertility rates, marriage levels, et cetera. I think housing, if you have what is today, what is a moribund housing market, I think the impact is significantly more intense than people think. So any of the initiatives, I think, to move it, I think fiscal, I think obviously moving the mortgage rate, I think is helpful. And by the way, I don't think you have to move it that far. We track prepayment speeds on mortgages, as you said, very, very closely. If you get the mortgage rate to 5.5 to 6, you've seen it, by the way, as the mortgage rate has come down, you create more velocity in terms of housing moving. You see it in existing home sales picking up. So anyway, I think that's the case. And I think if you get the mortgage rate down a bit, And by the way, I don't only think you need to get 10-year treasuries down 25, 30, 40 basis points and just keep them there and keep rate volatility down. And then with fiscal, I think you do some pretty positive things. And I agree that it's arguably one of the most important things we could do today.
Hey, Rick, does anybody ever talk about getting the fertility rate up? Like, why don't we put some carrots out there to create more kids?
So I don't know. I don't know if you know this. I'm actually becoming a grandfather today. So that's
Congratulations, Rick.
Yeah, no. So I think, by the way, Matt, I don't know if you know this, but I had my anniversary once when I was on your show many years ago. So I think all my big events come when I'm talking with y'all. So there's something good there about being with y'all. So anyway,
good for us, but you're in trouble at home, I imagine.
Yeah, that is. Well, I'm close. I think there's a couple of things that are play. I mean, I do think it's right. I do think if you have young people, look at the student loan, 30% of student loans are in repayment today. That is unbelievable. That stat is unbelievable. Young people are having a hard time. By the way, if you look at the youth unemployment rates now up, I think it's 8.5%, maybe a little bit higher than that. Young people graduating, you saw was at UMich or one of the surveys that showed people graduating college. It's the toughest time in literally a generation. So listen, I think there's some things. I think a lot of this is related. And I think a lot of this is, if we create initiatives, I think to Dani's question before that was dead right. There is something that that are just hard to fight against. But I think there's a series of things that I think that can be done that will improve a bunch of things. And by the way, the thing that is critical, nominal GDP has to be high because we have a debt burden in this country that is large. And if we keep nominal GDP high, we keep employing more people, you bring that nominal GDP number up, which diffuses the debt burden.
Rick, if we could talk about your other child, which I realize is less important than your grandchild, but still important for these markets. It is Bink. Matt has pointed this out. The fastest growing active ETF. You're talking about some seismic changes.
In history.
In history,
of ETFs,
in the world.
Which is huge. There's still more ETFs than stocks.
And a lot of active ETFs, too. So that is a big deal. And I'm assuming you're going to have to position this for big changes, lower rates, maybe changes with MBSs, or mortgage-backed securities, which I know is part of this. Maybe a tariff ruling, which could also change what this bond market does. And this brings me to a viewer question that someone wrote in. What is the best part of the curve that is the best place to invest for total return in 2026? How are you thinking incorporating that idea into Bink in 2026, Rick?
By the way, it's always funny when the chart that goes up that shows the price of Bink, it doesn't show the dividend yield. It's like my job is to create as much dividend yield and as much income as possible. Listen, I think, there's something, by the way, there's always an interesting thing about people say, why is he saying that the funds rate should come down? He must have an ulterior motive. I actually don't want the funds rate. In fact, I don't want interest rates to come down because commercially, these yields are phenomenal. I mean, these yields to create income in a portfolio, we can create 6.25%, 6.5% yield by being and staying high quality and staying, I think Bink is running a low single A rating, which is pretty amazing with a less than 4-year duration. Anyway, if we can just keep that yield up, so what do you do to do that? You reduce a little bit. We've reduced a little bit of high yield. We've increased a bit of emerging markets. We think the dollar is contained. We have talked about on the show. We like mortgages. Quite a move today. I don't know at these levels, but increase your quality, and you could still run yield that is pretty significant in the portfolio and be global. Look at interest rates around the world, particularly Europe, where you can, as a dollar investor, is quite attractive.
Is it, by the way, as you grow this quickly, we were just looking at the Eric Balchunas tweet there, and I have to think he's the foremost ETF analyst, most respected ETF analyst in the world. Is it more difficult as it grows to manage, or is it just such a huge space that you can't get that big?
Yeah, so by the way, it does, you think about in size, it's a fantastic question. There's a couple of things. First of all, part of why mortgages become more interesting is because they're so liquid and the size of that market is so expansive. You do think about other things, though, as you get larger that you can do in your portfolio where we can, we do a little bit more bespoke. We tend to keep this very liquid, but we can do a little bit more bespoke because of the size of it. So that gives us a little bit more flexibility. But there are some markets that are clear, like the CLO market or others, that you think about, how big do you want to be in certain markets? So it does evolve a little bit at scale. I think there's a lot of things that make it easier. to do it. I'd say on balance, it's a little bit easier at scale, but you do evolve it a bit in terms of how you're managing it, for sure.
Rick, how are you thinking about positioning heading into what might be a decision today on IEEPA from the Supreme Court? If we don't have as much revenue coming in, and if it is ruled illegal, what kind of changes could you see to this curve?
Yeah, it's a great question, and so first of all, a couple of things. This has been out there for a while. I mean, whether it's today or when it comes out. I will say one thing. I mean, we buy, including recently, we buy a lot of volatility in the equity market because, well, quite frankly, volatility is cheap in the equity market, whereas I think it's high in the rates market. But we buy a lot of volatility. We have been recently as volatility's come down, as you all talked about. You've had stocks go up, volatility comes down. So we have built a decent amount of protection in as people interpret it. I've talked about on your show before, I tend to like the front to the belly of the yield curve, particularly after a number like this, and they cheapen it up a little bit. The long end of the yield curve, not that interesting because of the volatility it gives you. So a few things around the edges around, gosh, can you hold a bit more front to belly of the yield curve? Can you buy a bit more volatility, protect some downside? And you were talking about in fixed income, maybe you go a little bit higher quality for the time being and wait for things to play through.
We had Stephen Myron on. He was on Surveillance yesterday, and he thinks that the Fed is still 150 basis points too restrictive. What are you watching in the data that could prove that out? Or what do you need to see in the next prints to show that the Fed is really behind the curve here?
I mean, I'm pretty resolute in my opinion. I've been for many, many months that I think 3% is a no-brainer in my mind, in that is an equilibrium rate. If inflation break-evens don't trade a lot. I'm not sure they're a great benchmark, but they're 2.3%. You're still above inflation break-evens. If you say, given what the labor market is telling you today, given that inflation, most of what is in inflation today is non-cyclical in services. We talked about shelter, and you could actually, if you drop rates, you bring shelter down. You build shelter inflation down. But things like healthcare, education, insurance, trash, and et cetera, like these things are not interest rate sensitive. So I don't think inflation is, we're going to hurt inflation by getting that funds rate to any lower because of so much of it is non-cyclical in inflation. So I think 3 is certainly a place you can rest. Whether we have to go lower, I guess to Dani's question about like what is over, if you have an economy that's not running 5% nominal and we start slowing because the fiscal tailwind becomes a headwind, does the neutral rate have to be closer to 2? I think time will tell. But I don't think we have to go that much lower today. But I don't know, if it was me, I would get the rate to 3. I would be focused on longer on the yield curve because that's where real velocity in the system works. That's where we finance mortgages, credit, virtually everything in the system finances out the curve in the 5s to 10s roughly.
Hey, Rick, if I may, and I've got to ask because a lot of people listen to you, really appreciate your opinion, and want to know if it will be you part of making that decision. The Treasury Secretary yesterday said that you were one of the sole candidates who haven't yet had your interview. Might you be headed down to Washington, D.C. anytime soon?
Yeah, no, you anticipated my answer. I'm focused on my family situation, as we talked about in terms of, and then, this is the busiest time, quite frankly, I've ever seen in terms of what we're doing. We've got a lot of year-end stuff we do, markets, funds were evolving, et cetera. So I don't know. I mean, I know it's a bad answer, but that's where I've never been more busy. So that's what I'm doing.
Well, Rick, I think I can speak for the entirety of the Open Interest family and wish you a congratulations to you.
Oh, thanks.
And
yes,
your
congratulations.
Family. Rick, thank you so much for joining us today. It's BlackRock's Rick Rieder.